I'm Shawn AG here. Shout out to my brother Malcolm Young for keeping it real in the comments, because that's the heartbeat of this channel. And before we go any further, do me a quick solid, press the like button right now. Not because I'm begging, not because I'm chasing algorithms, but because a lot of us are running on ADHD settings, and we genuinely forget the simplest stuff, even when we mean well. Hit it once, then let's get to work. Real talk, this channel was never built on smash that like, subscribe or else, or any of that performative internet stuff. We're not here to cosplay as gurus. We're traders and investors, breaking down markets for traders and investors. Real people, real analysis, zero hype. Cold logic, hard numbers, clean breakdowns. When I look at likes and comments, it's not me chasing validation. It's a pulse check. It tells me whether the squad is locked in or if I'm talking into the void. The real ones show up, drop a word, drop an emoji, challenge a point, add a data point, and that's how I know we're building something bigger than noise. And yes, the Economic Ninja episode is coming soon. Me and the team have been putting in serious hours. The kind where you blink and it's a different day. It's going to land different because it's not just one headline or one chart. It's the whole chain of cause and effect, policy, incentives, flows, and where the pressure points are. Stay ready. Now let me tell you why I had to reread a forecast 3 times today. A Bank of America outlook crossed my desk. And according to the way it's being discussed, they raised their gold price target to $6,000 an ounce by mid-2026. Not $5,000, 6,000. That's a line in the sand that forces you to ask a deeper question. What are the big institutions seeing that makes them comfortable putting a number like that on paper? Because banks don't say things like that casually. They don't like looking dramatic. They like being early quietly, then acting like it was obvious later. Here's the setup as of the time this was framed. Gold around $450 per ounce and silver around $103.93, with the gold-to-silver ratio sitting near 48.1, one of the tightest readings since 2013. If those levels sound wild to you, good. You're paying attention, because when the ratio compresses like this, it's usually the market hinting that silver is no longer sleeping. And if gold is truly on a path toward $6,000, the silver math starts making people uncomfortable. Let's slow down and do this like professionals. I'm not here to promise you a timeline. I'm not here to sell you certainty. I'm here to show you the mechanics. Gold is the monetary thermometer. It responds to confidence, currency purchasing power, and the credibility of fiscal and monetary policy. Silver is the monetary thermometer that also gets used up in the real economy. That difference is why silver can move like a regular asset one day and like a runaway freight train the next. The Bank of America case, as summarized, points to unorthodox U.S. fiscal policy as a primary driver. Translation: massive budget deficits, debt to GDP pressure, and a political system that keeps choosing spending today and payment later. When deficits become the norm, the incentives always tilt toward financing methods that dilute purchasing power, directly or indirectly. You can argue about the packaging, but the effect is the same. Currency confidence gets tested. In that environment, gold tends to catch bids because it's the asset people reach for when they want something that doesn't depend on a promise. That's why you're seeing a cluster of institutional forecasts marching upward. Some are calling for average gold prices around the mid-$4,000 in 2026 with upside into $5,000. Others are talking about $5,555 late 2026 averages and longer-term $6,000 cases. Still others are more conservative, landing around $4,500 by mid-2026. What's significant isn't that they all agree. It's that the whole range has migrated higher. 2 years ago, most of these same names were comfortable living in the $2,200 to $2,500 neighborhood. Now the conversation has shifted to a world where $5,000 is not a fantasy number. It's a checkpoint. So what levers can push gold into that kind of territory? The first lever is central bank gold buying. This has moved from occasional to consistent. Sovereign institutions have been adding gold at the highest volumes in decades, with 2024 and 2025 often cited as record-setting years for official sector purchases. And here's the key. Central banks are not price-sensitive the way retail is. They don't take profit because the candle looks extended. They accumulate for strategic reasons. They want reserves that can't be frozen with a keystroke, reserves that aren't somebody else's liability, reserves that hold weight when geopolitics turns ugly. That trend accelerated for a lot of countries after 2022, when the world was reminded that reserves can be weaponized. The second lever is portfolio allocation. Many professional portfolios still hold surprisingly small allocations to gold. Some research frames it as roughly 0.5% in parts of the investment world versus optimized levels that could be far higher. Whether you agree with those model targets or not, the point stands. If large pools of capital shift even a few percentage points into gold, the demand shock is enormous because the market's ability to absorb new demand without higher prices is limited. The third lever is supply. People love the idea that high prices instantly bring high supply. That's not how mining works. Ore grades decline. Permitting takes years. Capital costs rise. Energy costs rise. Skilled labor is finite. And the report discussion points to production softness and rising all-in sustaining costs, with costs being framed around when the U.S. makes $100 an ounce and rising. That doesn't mean miners can't profit. It means supply isn't elastic. The market can't be flooded quickly, even if prices scream. Now let's talk silver, because this is where the story goes from interesting to potentially explosive. If gold reaches $6,000 and the gold-to-silver ratio stays near 50.1, silver prices imply around $120. If the ratio compresses to 40.1, you get $150. If it compresses toward the 33 to 35 range seen in certain historical eras, you're talking roughly $171 to $181. I'm not saying those numbers are guaranteed. I'm saying this is what happens when you take a gold target seriously and pair it with a ratio that's already tightening. But silver is not just ratio math. Silver has been running a supply deficit story that refuses to go away. Industry sources like the Silver Institute and Metals Focus have described several consecutive years of structural deficits. Figures cited for 2025 often land around a 95 to 117 million ounce shortfall, with total demand around 1.24 billion ounces and total supply, including mine production plus recycling, around 1.12 to 1.14 billion ounces. That means each year you're drawing down inventory or forcing price to ration demand. And the moment you understand deficit as a persistent condition, you start respecting volatility differently. A balanced market can take a punch. A deficit market is brittle. In a brittle market, small disruptions become big moves. A shipping delay turns into a premium. A policy shift turns into a scramble. A single month of strong investment inflows turns into a supply squeeze. Silver's demand is also split in a way gold's isn't. A large share of silver demand is industrial. Silver is used because it is the best conductor among metals. It performs in high reliability applications, and it has properties that are difficult to replace at scale. Solar is a big one. Electric vehicles are another. Electronics, semiconductors, medical tools, coatings, chemical catalysts, silver is embedded across the system. You can reduce loadings over time, but you can't just wish it away. And when the world leans harder into electrification and energy transition, you're basically voting for more silver intensity in the supply chain. At the same time, investment demand can surge at the worst possible moment for supply. A detail that keeps getting highlighted is ETF and physical-backed product inflows, with one widely circulated number being 187 million ounces of ETF inflows in 2025. Whether your exact number differs by source, the point remains. When capital decides silver is a hedge and not a hobby, it pulls metal out of circulation. Now add a geopolitical choke point to that already tight market. Reports circulating claim that on January 1, 2026, China implemented new export restrictions on refined silver, limiting exports to large, state-approved entities that can secure special licenses and meet production capacity requirements, with thresholds like 80 tons annually being mentioned. China is often described as controlling a major share of refined silver supply, sometimes cited in the 60% to 70% range. If even part of that refined pipeline gets constrained, global supply chains feel it instantly, and the physical market tends to reveal stress before the headlines do. One of the loudest signals is leasing. When lease rates spike, it's the market telling you physical is hard to source, and financing is tightening. Numbers around 8% for a one-month term have been mentioned in discussions of the January squeeze. That kind of move is not normal trading. That's a scramble for metal. And when industrial users need silver for production, they can't just wait for a better entry. Factories don't run on hope. They run on inputs. Now let's give the bearish case the respect it deserves. The first risk is the Federal Reserve and real rates. If policymakers stay hawkish, if yields remain attractive, it can pressure non-yielding metals. The second risk is recessionary demand destruction. If manufacturing slows, industrial silver demand can soften. Some forecasts already point to slight declines due to uncertainty and policy friction. The third risk is substitution. At high enough prices, engineers and procurement departments will fight back by reducing silver per unit where possible or shifting designs when performance allows. The fourth risk is that investment flows reverse. If ETF inflows flip to outflows, that metal can come back to market and lean on price. The fifth risk is supply response over time. Higher prices can encourage recycling and incremental mine output. But that's not instant, and it rarely arrives neatly on schedule. Here's why those risks don't automatically kill the thesis. They mostly explain the path, not the destination. They explain why you get violent pullbacks, why rallies don't go straight, why weak hands get shaken out. But they don't change the arithmetic of a market that consumes more than it produces, especially when new policy friction hits supply chains. And look at what the tape has already done. Silver reportedly hit an all-time nominal high, around $103.45, on January 23, 2026. That's above the previous peaks people remember, like $49.45 in 1980 during the Hunt Brothers era, and around $48.70 in 2011. If those reference points are burned into your brain, you understand what it means to see triple digits. It means the market is repricing. It means old anchors don't hold. So what does this mean for how you operate? If you're a physical holder, your game is positioning and patience. Physical isn't about leverage. It's about owning the asset that the system can't print. Your risk is not getting margin called. Your risk is buying at a terrible price and losing discipline or ignoring liquidity and storage realities. If you're a futures trader, understand volatility is the product. Margin requirements can change, and if exchanges shift to percentage-based margins as prices rise, the cost of leverage rises with it. That can force paper players out at the worst moment, which is exactly why these markets can get so violent. If you're looking at miners, remember they're not silver bars with a ticker symbol. They're businesses. They carry operational risk, jurisdiction risk, management risk, dilution risk, and cost inflation. You want low all-in sustaining costs, clean balance sheets, and realistic production profiles, not marketing decks. And if you're holding paper claims, keep an eye on physical premiums and inventory drawdowns. When the physical market tightens, paper can lag reality until it can't. The gold-to-silver ratio is still the key dashboard. It has already compressed dramatically from the extremes seen in 2020, when it was over 100.1, to the mid-40s today. That compression tells you silver has been gaining ground. If gold moves toward $6,000 and silver remains suppressed, the ratio would widen again, making silver historically cheap relative to gold at the exact moment silver's fundamentals are arguably stronger. That mismatch doesn't usually persist. Markets correct. And in tight commodity markets, they don't correct politely. This is bigger than price speculation. This is a tug-of-war between physical scarcity and paper promises. Futures contracts can settle in cash. They can roll, they can be managed, but factories can't build solar panels with cash settlement. If annual demand is around 1.24 billion ounces and supply is around 1.12 to 1.14 billion, something has to give. Either prices rise high enough to ration demand, or supply expands over time, or both. In the near term, none of those outcomes are comfortable for people who want the market to behave like a stable, well-stocked grocery aisle. So when Bank of America talks about $6,000 gold, they're not just throwing out a number. They're validating a thesis: fiscal strain, currency debasement pressure, central bank accumulation, and investor reallocation. And if that thesis is right for gold, it can be even more powerful for silver, because silver carries the extra fuel of industrial draw. Now let me bring it home. Don't confuse excitement with strategy. Don't confuse a bullish thesis with permission to ignore risk. Volatility is part of the deal here. Respect it. Plan your entries. Plan your exits. Know what would make you wrong. Watch the ratio. Watch the policy signals. Watch inventories. Watch lease rates. Watch premiums. Watch ETF flows. That's the work. And keep the community energy alive. Drop a comment with what you're watching and why. If you're tracking the ratio, say where you think it can compress. If you're tracking physical, tell us what premiums look like in your area. If you're trading, tell us where your invalidation is. That's how we stay sharp together. One more layer people miss is how fast models get left behind once silver stops acting normal. Bank of America's Silver Outlook, as it's been quoted, talked about silver averaging around $60 in 2026 with big volatility. But if spot is already above $100 in January, that gap tells you the market is repricing faster than institutional forecasts can update. And if the physical side is as tight as the chatter suggests, you can see weird disconnects. When exchange inventories drain, when delivery queues get messy, when premiums stay elevated even on pullbacks, that's the physical market asserting itself. The paper market can whip price with leverage and margin changes, but it cannot manufacture metal. Corporate behavior matters too. If industrial users are signing multi-year supply deals at premiums like 20% above spot, that isn't a trade. That's fear of non-delivery. It says, I would rather lock supply now than risk shutting down later. In a deficit market, That kind of demand doesn't blink at your indicators. So yes, manage risk. But don't sleepwalk through what the structure is saying. Tight ratio, persistent deficits, policy friction, and big money targets moving higher at the same time is not business as usual. It's a regime change, and regime changes reward the disciplined. Economic Ninja is coming soon, and it's going to connect these dots in a way people can actually use. Until then, stay logical, stay ready, and before you scroll away, press the like button. It helps more than you think, and it keeps this squad moving like a real desk, not a random timeline.